Hey everybody, happy afternoon. Today is Tuesday, January 13th. My name is Matt Sochi. I am the owner of Anchor Home Loans, LLC, here in Naples, Florida. We lend in Georgia, Florida, Texas, Tennessee. And for what we're talking about today, DSCR loans, fix and flips, and rehabs, I actually do these in over 40 states. So if you've ever been told that you don't make enough on paper to invest in real estate, it's bullshit. Just throwing it out there. Most real investors don't qualify the traditional way, which would be like a conventional loan or an FHA loan, which you wouldn't do an FHA loan on an investment, but conventional loan for sure. And that's exactly why DSCR and rehab loans exist. Today, I'm going to be breaking down how investors actually get started, how to find the right deal, how we qualify you without your tax returns, and how to close in an LLC for what I like to call asset protection. And then we're going to get into fix and flip rehab loans. This is a new venture for me, but I'm really excited to partner up with a great lender that's going to help broker these deals and make them amazing for you and keep those costs out of your pocket. The kind that let you scale fast if you know what you're doing. I'm not just a lender on these deals. I'm an investor myself. I lived the mistakes that go out there, the things that happen, the wins, the losses, and the learning curves. Let's get into it. So first part, we're going to talk about what a DSCR loan actually is. You know, going back 5 years ago, nobody really knew what these loans were. I was what I feel is the first adopter of this because when I got into the industry, I was always looking at avenues of how to increase my business and how to help more people, partners, investors, or home buyers just grow their real estate portfolio. So a DSCR loan, we're going to talk a little bit about this. It's a very popular one right now, and it stands for debt service coverage ratio. So what that means is we qualify you off the property and not you personally. I'll be honest with you, you can make 30 grand a year and maybe have $100,000 in your bank and you could buy an investment property and we don't care about your tax returns. We don't care about your W-2s. You don't have to explain any write-offs. And the question is simple. Does the rent cover the mortgage? Does the rent cover the mortgage? That's how you get qualified for these. That's a debt service. All right. And that covers the ratio. That's the DSCR loan in a nutshell. So if the property can pay for itself, lenders are willing to fund it, period. Very simple, okay? And to some people, it doesn't make sense. They don't understand the lingo. They don't understand the term DSCR. And I want to let you know out there that it's not something to be scared of. It's a really great product. A lot of investors do it. And the more that you have, the less that you could typically put down. So let's get the facts out. You don't need to be a millionaire to do these loans. You don't need 20 properties already. But what you do need is a decent credit profile. You know, the stronger the credit, the better the rates, better the term, the better the money flow is, everything else. But we can't go down to super low credits. You know, I it gets really rickety when you get into the lower 600s. But if you're in the mid 600s and up, we can make it happen. Preferably, you want to be in the 700s for the credit scores on these to have a really good rate. And I'll give you an example. I just put a purchase in, and the rate was like low to mid sixes, okay, with 20% down. So they're really, really attractive. And the rates on these are not much higher than what a conventional loan would be. If not, they are a lot lower than a conventional loan because they don't have all those price adjustments that the FHFA has on second homes and investment properties. So you definitely want a decent credit profile. Down payment, I always say 20%. The more you put down, the better. We do have some lenders that do offer 15% down if you have experience, but obviously the terms on those are going to be a lot out of your advantage versus putting 20% down. The biggest thing though, is having the down payment and having reserves. And not everybody knows what reserves are. So let's go through that real quick. Whatever the mortgage payment is times 6, usually you need 6 months reserves, is what you need to have in excess funds of assets after closing costs and down payment. We don't touch the funds. You got to show that you have them and they're liquidable. Okay. That's about it. It's very, very simple. Now, the tough part is finding the right property. And that's where I come in with your realtor partner. And we make sure that we're not getting into something that's not going to work. Actually, some of our lenders will do, the pre-work up front before we go under contract to make sure that it is a deal that makes sense. And that's the best part about working with someone like me is that you get those connections, you get that feedback, you get all those good things to make sure that it's going to be a great deal. So the truth bomb here is most first time investors don't fail because of financing. They fail because they buy the wrong deal. I can't tell you how many times I've seen deals that just implode because it wasn't structured right, or the house was 800,000 and they're mortgaging 600,000, but the rents are 3,000. Obviously your payment's a lot higher than that. Doesn't work. Okay. Now we do have options if the DSCR ratio is lower. So let's just say you don't have that 1-to-1 ratio, the rent covering the mortgage, and let's just say it's covering 3/4 of the mortgage. We could still get it done. The terms change a little bit on that, but we could still get you into the home, get you into that investment property. So, how do you find the right property? This is where things become really important, and you have to be seasoned. All right, numbers before emotions. When you're buying an investment property, you're not going to live in it. Period. That's a second home. So when you're buying an investment property, you got to think of certain things. Rent, the rent comps matter more than the counters or the granite countertops. The rent comps matter more than the color of the house. All right. These are things you got to look at. Now, a lot of my realtor partners that are very good and understand what DSCR and the non QM sector is for mortgages, they already know this data. So when they get me a client, it's a really great conversation. It's easy, fast, and we can close these deals quick. So those are things to keep in mind. It's that cash flow is greater than flashy appreciation stories. So you got to kind of look at the market where you're buying these. For example, Florida might not be the best market for that. Our prices are high. The rental income might not be very aggressive. I'll tell you what, I'm doing a ton of these deals in Ohio right now, and you could buy a house for like in the hundreds, like 150, 160,000. And the rents, I'm getting these DSCR ratios, they're all coming in at 1.5 to 2 compared to the mortgage. The lenders are eating it up because that's amazing. Where in Florida, sometimes we do have a little struggle with that just based on high price points, lower rent. Finding the right market to do these is very, very important for your success as an investor. And we have to make sure it works. Otherwise, it doesn't work for a mortgage. So we also have different options too. So we have short-term rental, which would be like Airbnb, VRBO, seasonal if you're down in Florida, versus long-term rental. So you have a lease in place that's 12 months or greater. So long-term is obviously more stable. It's boring, but it's predictable. Where short-term rental, and me and my wife have one up in Blue Ridge, Georgia, you have a higher upside, but then again, you could have more management costs, more rules, but you also have the fluctuation of seasons. So sometimes, for example, in North Georgia, yeah, the Florida people love to go up there and get a blast of the cold weather, potentially some flurries and some snow. When the summertime, you could do all the outdoor activities, kayaking, boating, river, floating, whatever you want to do, fishing. So, like, you got to know the seasons and make sure you buy, if you're doing short-term rental using Airbnb data for that income, that you're buying in the right area because certain markets typically are not good for that. So that's something to throw out there. But not every property should be an Airbnb, but the right one in the right market with the right numbers. And that's where the DSCR shines. There's a cool website out there called AirDNA. You can pay for a zip code. You actually get all the Airbnb and VRBO data. So before you buy or put an offer into a house, you could kind of have an idea of what it goes for as far as the rental comps and the income on that property. Now, with some of my lenders, they have that access for free. So you're not spending a couple $100 on a zip code. So we could preemptively figure out, hey, is this still going to work with the interest rates and what we're looking to do with the down payment? And I always tell my clients, it's not really up to us if you're doing long-term rental because it's up to the appraiser to pull the comps, right? So if there's a lease in place, they're always going to use lesser of the two, the appraiser comp of the rent or the lease. Now, if there's no lease, then they're just going to use what the appraiser determines what the market rent is. So very, very important things to understand when doing these type of loans. But let's dive into how we qualify you on the process. So obviously you fill out an application. I'm going to review your credit with a soft pull, make sure I don't care about the liabilities. You could have $1 bazillion in debt, but we want to make sure the scores are good because we got to match that up with a rate. I do a property analysis, just looking at the property, getting feedback from the realtor, but also other data points that we have for what that rent is approximately. And we work together on that to make sure we're not getting ourselves over ahead. That will explain the DSCR ratio to make sure it works. Then if everything's good, you go under contract. We simply put it in with one of our lenders. I have a bunch of non-qualified mortgage lenders that they specialize in this. We order the appraisal and then we close. As long as all works out. So this isn't a bank loan, it's an investor loan built for speed and scalability. That's the beauty of it. But my favorite part is talking about asset protection, closing in an LLC. So let's talk about a few things here. So if you've been thinking about buying a rental property using this type of loan, you could actually close it in an LLC. Okay. What you need to do is, depending on your state, go to the entity for the state. So in Florida, it's here, SunBiz. Every state has their different one. Create an LLC, a couple $100, create, however many members there will be. So if it's just you, one, you and your wife, two, you and a business partner, two, figure it out, get it all set and squared. It's going to take a couple weeks, could be shorter, could be longer, depending on your state. Get that squared away today. To maintain an LLC, a couple $100 a year. Once the LLC is approved, you're going to want to go to the IRS website and get an EIN number. That's very important. A few of my lenders, we could close the deal in your LLC by your tax ID so it doesn't hit your personal credit, which makes it really, really bulletproof for you as an investor in case shit hits the fan. All right, just want to make sure that's clear. That's what we call asset protection. All right. So you will be the personal guarantor of the loan in case your business doesn't pay for the loan. But at the end of the day, it protects you as an individual in case anything were to happen with the property. So the cool news is DSCR loans allow LLC ownership. If you do a conventional loan, you cannot do it under LLC. You would have to do a quick claim deed and then hope that that mortgage company doesn't call the mortgage due. Okay. Very, very important. And your rates are probably going to be a lot higher. But it also allows you to separate your personal assets from your personal assets from the investor risk. And for tax purposes, it makes it a lot easier to do your taxes since this is a business producing property, a business mortgage, essentially over 30 years. That's going to make it a lot easier to write off things and keep control of your bookkeeping. You want cleaner bookkeeping when you do your taxes. I'll tell you what, our cabin up in Blue Ridge, Georgia saves our butts every single year with tax deductions. Okay. We have a Schedule E, collect our rents. We have our payments out to the cleaners, maintenance, whatever it might be that are all tax deductible, including the interest on the mortgage and the taxes. A lot of great benefits because at the end of the year, I'm like, thank God we have this property. So, important disclaimer, I always say, I'm not a CPA or an attorney. I'm a mortgage broker. I own a brokerage, but always talk to a CPA or attorney. But from a lending standpoint, these loans are designed for business-minded investors. And we don't have limits of how many properties you can have like you do with a conventional loan. Let's talk a little about short-term versus long-term rentals. So the flexibility. So DSCR works for long-term, as we talked about, and short-term, in which we talked about, which would be Airbnb, VRBO, and direct booking. Some lenders use market rent. Some allow short-term rental income projections. So the right lender matters. The wrong lender will kill a good deal. That's why people like to work with me. I have a bunch of lenders. Yeah, sometimes things happen, but I could always move it to another lender and we have more options. So it's not like you have to go make calls and start all over. That's the nice thing about Anchor Home Loans. We are a one-stop shop for you and on these loans in like 40 different states. All right. So keep that in mind. I know it's a lot of information in a short period of time, but you could always go back and rewatch this. So this is what I'm super excited about. The second part of this podcast is fix and flip loans, rehab loans, and what these loans are. So here's the cool thing. You can find a property. You definitely want to try to get some experience under your hand for sure, because it's definitely going to help. The more experience you have, the higher tier you are as a client. But you could purchase a home plus finance the rehab. Okay. And it's based all off of ARV, which is after repair value. So short-term money for active investors. So I have a few investors who have done conventional loans, DSCR loans, but then they go ahead and remodel the house and they're coming out of pocket with their own money. All right. What that does is that ties up your cash. All right. So you can't scale. You have to wait until you're going to have to pay out all this money, rehab the loan on your own, and then you have to sell it. So that could take time, right? Especially in a market, depending where you are, where maybe things don't move as fast. Well, here's the beauty of this is that if you have some experience of owning homes, flipping homes, and it's really, I mean, the last 3 years is good, but I think if we could go back a lifetime, that think about it. If you could buy a house, and I'm going to use easy numbers, $1 million, okay? The homes that are selling that are updated, remodeled, look fantastic are selling for let's say 2 million. Okay. You walk the property with your realtor, you get a contractor, and they say, okay, we need to put in, I don't know, let's call it $300,000. All right. Well, if you do the math on that, as long as your ARV, so I'm going to get my calculator. So 2 million times 70%, that puts you at 1.4 million, right? So 2 million times 70% is 1.4 million. If we're putting 300,000 finance rehab, that's 100,000 left over. Some of these lenders, and keep in mind, we do 15%, we could do as low as 15% loan to cost. All right. There's a lot of math in there, so I won't get into it. You can always reach out to me of what that is. So instead of you putting 20 to 25% down and coming out of your own pocket, you could fund the whole deal for 15% down. Think about that. And instead of you spending $300,000 of your own money, you're financing it through the lender with quick draws. So you could buy like 3 of them at once compared to one and have more cash flow. Now, if the ARV is super good, right? So you have you could actually defer the payments. So you have no payment for up to a year. That's wild to me. Okay. And shame on me for not really diving into this sooner in my career, but I'm always looking for opportunities. And this is a great one for people out there. So this is not a 30-year fixed mortgage. This is working capital. And then once you're established and you find another deal, they could close them in like 7 to 10 days. I mean, think about that. So it's basically like you're offering cash, you're financing the whole thing with an out strategy to sell it, or you could refinance it. I mean, if you want to keep it and do like a rental for it. But I think the end of the game for these type of clients is to make as much money as possible. So let's talk about how they work. So lender funds to purchase, rehab funds are held in draws. So if you need more money, you just call it in. Usually within 1 to 2 days, you have the money. You renovate, you sell, or refinance out, and that's it. So these type of loans are for new flippers with guidance. We help you with that. Actually, one of my account managers, we got on a call last week with the client. He's very, very knowledgeable. He did all the homework before the call. And the deal was kind of like, on the borderline. It could be possible, but it would really come down to the ARV. Where my client got offers from other people with like, you only have to do 10% down, loan to cost, yada, 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 lower rate, but they wouldn't even be able to do the deal. Okay. So I always tell people be careful what you hear and listen to, because the reality is you need to work with somebody strong who understands these things. So that way you're not wasting your time and money for nothing. All right. And I say that a lot. But it's great for experienced investors to scale volume, because the only way you make money doing this stuff is to have volume. So like if you do $100,000 fix and flip and you sell for 150, you're not making money. So like the fact that you can put less down, buy a bigger house and have higher margins allows you to make more money and quicker. And then also it just adds value all around. So common mistakes you might see is, this is where your experience really shows, is my experience shows, is underestimating rehab costs, right? So if you're really luxury, well, you got to budget luxury in. If you're kind of basic, it's basic, but you got to understand the rehab costs and really have a good GC or a real understanding of what those costs are going to be. Some people, they get emotional, they have this high dream, right? And they overestimate the ARV. Well, that's why our lenders will actually do the homework, look at comps out 10,000 feet or so to see what's in that area, 1 to 2 miles out, to see what's actually sold. So you might have one at 1.5, not remodeled, nothing redone. You might have one at 1.9. Well, we got to start thinking like, what's that value going to come in? Is it going to come at the high end, in the middle, or the low end? Because if it comes in anything less than the high end, it's a bust. And that's why it may not be a good deal. And our advice would be is to try to find another deal, right? It's not about falling in love with the house. It's about finding the right deal that's going to make you the most money in ROI. Some people don't have exit strategies. Got to have an exit strategy. That means you got to have these conversations before you go under contract. You can't wait till you go under contract to start figuring this all out because you waste time. You're going to get 100 million different answers. It's good to do these things up front. And this is where we can help you do those things. The deal should make sense before you ever call a lender. All right. And I'm going to help you structure it, but the numbers have to work. So, a lot of information today. I want to do another podcast on some other crazy shit that I heard today, but I'm not going to. I'll save it for tomorrow. But loan officers, if you're out there, you really got to start doing your job. I can't tell you over the last 2 weeks how many realtor stories I've heard of things going super south, how many buyers think they're approved for way more than what they can actually qualify for, whatever. Like, people need to start doing their job and doing their due diligence and educating people. And if you're a realtor out there, you got to start asking more questions. I'm sorry to say that, but you have to start asking more questions because otherwise you're wasting sellers' times, buyers' time, money, all the things, and you're getting all excited and then it all goes to shit. So I'm just throwing it out there. I'll talk about that tomorrow. But anyways, going back to this. So if you're serious about investing, not just scrolling through Zillow, reach out. It could be a conversation. We could talk about your strategy. We get you on the path to whatever it is, ownership, investing, whatever, Airbnbs, VRBOs, cabins, whatever, commercial. I do it all. All right. So whether it's your first rental, your 10th rental, a short-term rental, or a fix and flip, the strategy matters just as much as the rate and the product and everything else. And that's where I come into play. So I do this every day. I invest in myself and I'll tell you straight whether a deal works or not. If it's a good fit, reach out. Let's map out your next home. And here's some questions that some people have asked me. So it's like 3 questions. So can I do this with multiple properties? Well, the answer to that question is yes. All right. There's no debt to income ratios. As long as it works and you have the assets to do so in the reserves, you're good to go. How fast can these close? So this is a great question. On the fix and flips and rehab loans, extremely fast. All right. Again, they're not underwriting you, they're underwriting the property. You just got to show that you have liquidability and net worth and it makes sense. For DSCR loans, as fast as everybody can move. That's client, appraiser, title/attorney, lender. Typically, DSCR loans, they could close as fast as 2 weeks, can take up to 30 days. Just really depends. What credit score do I really need? It gets really ugly under 640. Okay. I have a free credit repair journey app that I could send to you. Just shoot me a DM. I'd be happy to send it to you. It's really cool. You actually put your information there, tells you what you qualify for. It knows based off your credit and what you put for your income and everything else. But I also get notification when your score increases. So I could help you with that as well. It's like a Credit Karma for home buying. So I hate Credit Karma. I shouldn't have used that analogy. Experian for home buying. Okay. It's all free. I pay for it. So that is another avenue as well. And if you have questions outside of what we covered today, you could reach me very easily. My email address is Matt, M-A-T-T, at anchorhl.com. You can send me a DM on my Facebook, Instagram, preferably Facebook. You could call me 239-666-5005 or reach out to me any way that you could get a hold of me because I'm always available. So it's not really hard to do. But hopefully you got some nuggets out here. I'm excited about this new endeavor of mine, fix and flips and rehab loans, getting a lot of traction on it. And they're really good programs and very short term, easy money to get a hold of. So if you're out there and you've been thinking about buying maybe a cabin up in Blue Ridge, Georgia, mountain home in Montana, whatever it might be, just reach out to me. I'd love to talk to you about your goals and we'll make it happen. And remember, my name is Matt, Anchor Home Loans LLC, owner and broker. And me and my team would love to help you on your journey, no matter what it is. First time home buyer, experienced investor, fix and flip, HELOC, you name it, we do it. God bless everybody, and we'll talk soon.